Nasdaq futures slump after a cheaper Chinese AI model sparks panic in Silicon Valley. DeepSeek is a Chinese startup that's launched a free AI assistant it says uses lower-cost chips and less data than Silicon Valley's models. That means that if it's as effective as OpenAI, big market bets on high-end chips and data centers will look like they've backed the wrong horse. In overnight trading, Nvidia was down 6.9% earlier on that news, and Microsoft and Meta are also steeply lower. Joachim Clement of Panmure Liberum has been playing around with DeepSeek all morning. How much of a threat is it, Joachim?
Well, from a user experience point of view, it looks quite good. It is about as good as ChatGPT, but the big differentiator is it explains to you what it does and why it comes up with the solutions, which is a much welcome feature.
Can US firms compete then by offering more computing power and more investment, like the $500 billion Stargate tie-up announced last week?
I think so. I think the capabilities of DeepSeek are well within reach of OpenAI and the other providers of generative AI. But, and that's the crucial but, is can DeepSeek approach or get the same results with lower infrastructure costs, which obviously would be a major negative, not just for Nvidia, but also for the big cloud computing data center providers like Amazon.
What could this mean then for Nvidia and other chip makers if Chinese engineers have developed this both more cheaply and despite US export restrictions on the highest end chips going to China, of course?
Well, it would certainly take a major dent to the growth prospects priced into these stocks, and as a result, we would expect lower share prices. Now, whether that is going to really happen in the next 6 to 12 months is still an open question, because we're really just playing around with DeepSeek and see what it really can do and what it cannot do.
Where does it leave firms like Meta and Microsoft, who both recently announced tens of billions in capex spending on AI?
Well, we've seen a series of large announcements for large capex spending, not just Meta and Microsoft, but TSMC in Taiwan as well. And that is what has driven share prices higher in the beginning of this year. Now, it is going to be crucial with earnings results later this week for some of these companies to see what their outlook for capex and revenues is for 2025 and then potentially even into 2026. Any disappointment on that side will probably have trigger a larger than expected negative share price reaction, given the news from DeepSeek today.
You mentioned that Meta and Microsoft, along with Apple, of course, report this week. Is it getting to a point where they need to show shareholders a profitable use case for this?
I think not yet. I think investors are still pretty happy to work on the assumption that we're still ramping up investments and proper use cases have to come up in 26 and 27. But we have to be careful. Earnings growth estimates are coming down from the massive growth that we've seen last year. And as these growth estimates come down, long-term growth estimates will have to come down as well. And this is where Microsoft, but even more so Nvidia, are very vulnerable with estimates, consensus estimates for long-term earnings growth in the order of 20% for Microsoft, but 35% per year for Nvidia.
That was Joachim Clement of Panmure Liberum. Don't forget, you can watch more videos on Reuters.com.